Hello, I am Carlo Bustos, Educational Programs Leader at Proformative, the online community for corporate finance, accounting, treasury, and related professionals. I'd like to welcome everyone to today's webinar, Understanding Lease Accounting, an in-depth preview of the Leases Project Exposure Draft. Today's webinar will be an in-depth preview of the new Lease Accounting Exposure Draft led by an industry expert. Our speaker today will provide an overview of the proposed accounting rules for lessees and project's timetable. The focus will be on lessee accounting, providing details of the proposed accounting methods and commentary on the impacts to lessees. Just a few items before we get started. First, I'd like to welcome you back to Proformative. If this is the first time for most of you to Proformative, welcome. We are the largest growing online community of finance, treasury, accounting, and related professionals. We are an ad-free, noise-free community where we encourage and expect peer-to-peer collaboration. Check it out at proformative.com. And now just a few housekeeping items before we do move on. Just a reminder to the attendees, the links to today's presentation as well as the link to the recording of this webinar will be sent out to all attendees within 24 hours of this event. And the presentation is currently posted on proformative.com/resources for you to download and follow along. For those of you who'd like CPE credits, you will need to answer all 3 polling questions during today's event and should have pre-registered for it. For any questions, please contact Chris Brower at proformative.com. We encourage questions to be asked throughout the event. We will hold a Q&A session towards the end of the event. You will utilize, or you could utilize the questions box within your GoToWebinar control panel at any time to ask questions. For whatever reason we do not get to your question, we will work with the speaker to follow up with you directly to answer those. And lastly, you will be asked to take a short survey today regarding this webinar. We greatly appreciate your feedback to today's event as we always strive to improve how and the way we deliver our content to you, the attendees. And just a few learning objectives before we do get started. After participating, you will be able to make aware of, or you'll be more aware of the lease exposure draft and the comment period. You'll also have a better understanding of the new proposed rules and also highlight some of the controversial issues and better awareness of those proposed rules. So without further ado, let's get started. I'd like to introduce today's speaker, Bill Bosco. Bill is the principal of Leasing 101, a lease consulting company. Bill has over 35 years experience in the leasing industry. His areas of expertise are accounting, tax, financial analysis, structuring, pricing, and training. He has been with the Equipment Leasing and Finance Association Accounting Committee since 1988 and was chairman for 10 years. He's a frequent author and speaker on the leasing topics. He has been selected to the FASB IASB Lease Project Working Group as well. Bill, the floor is yours.
Okay, thank you very much, Carlo. And welcome, everybody, and thanks to Proformative for allowing me to make this presentation. The agenda will be talking about the timing and status of the exposure draft, which is scheduled actually to come out tomorrow if they make their schedule. Give you an overview of the lease model, talk about the different types of leases, focus on lessee accounting, but also talk somewhat about lessor accounting. And the reason for that is there are many more lessees than there are lessors. And then talk about the implications and allow some time for questions and answers. This is a timeline of the project. It started out as a discussion paper in 2009. Got quite a few comment letters. Then there was a first exposure draft in August of 2010, which got some 786 comment letters. And significant changes have been made such that the boards felt that there should be a second exposure draft, which is expected to be issued, as I said, tomorrow. And based upon their projections, what happens is there's a 120-day comment period. The staff reviews the comments, takes from the comments the issues that they think the board should focus on, in redeliberations, which would probably take us into the fourth quarter of 2013 before they even start to look at possible changes to the second exposure draft. So the project will flip over into 2014 for any continuing redeliberations, and so we wouldn't see a new standard issued until sometime in 2014 if all goes according to their plans. Then there's an effective date. Even though the standard might be issued in 2014, there will be an effective date sometime in the future, not likely to be before 2017, when all lessees and lessors will have to account for all leases under this standard. And this is a convergence project, which means that the FASB, Financial Accounting Standards Board in the U.S., and the International Accounting Standards Board, or IASB, have worked together, and they'll come up with basically the same standard with some minor differences for things like impairment, where the two IFRS and U.S. GAAP differ. But the leases, the main lease accounting rules will be the same for all companies worldwide. Now, if the rules are effective in 2017, that means that companies will have to report comparative information for 2015 and 16, as well as their results in 2017. So once the rules go into effect, companies are going to have to take some fairly quick measures to implement systems and extract information on existing leases to transition to the project, as well as have comparative financial information. This is and now we're getting into an overview of the model, and these are the decisions that are the questions that had to be addressed by the board. They had to define what a lease is, decide what the lease term is, and what the lease payments are. But also they've made an effort to try to simplify things, and so they've decided to carve out short-term leases. And then they have to make decisions on how a lessee accounts for leases and allocates costs, and how a lessor accounts for leases and recognizes revenue. This is a kind of a snapshot of the lease models and their kind of the new regime that they're proposing. The new accounting rules are going to scrap FAS 13 and IAS 17, which are current GAAP, where under current GAAP, a lessee and a lessor account for the asset using a risks and rewards based classification tests that really decides who in effect or in fact owns the asset. So under current rules, either you have a capital lease where the lessee owns the asset and has it on balance sheet, and the lessor accounts for the lease as a financing, or you have an operating lease where the lessor owns the asset, has it on its books, and records rents as income and residual income as income. Whereas on the lessee side of things, it's off balance sheet. The asset is off balance sheet for the lessee, and the lessee accrues the average rent as expense and does disclose future minimum lease payments. But the new model is going to focus on accounting for the rights and obligations in the lease contract. And so a lease contract conveys the rights of use from the lessor to the lessee, and the rights to use an asset are considered an asset of the lessee. And the lessee is obligated to make lease payments, which will be an obligation that they'll account for. And the lessor will have, in most cases, a lease receivable. The lessor models will be basically three kinds of models. Short-term leases for both lessors and lessees. There's an option to use the existing operating lease model. And from a lessor perspective, the operating lease model is that the asset stays on the lessor's books, and the lessor records rent and residual as income, depreciates the asset. The lessor also, another lessor model will be a receivable and residual approach, which is very similar to current GAAP's direct finance lease model, where a receivable and a residual are recognized and the property is derecognized. Now, there are new lease classification tests that are consistent for both lessees and lessors to define which assets get operating lease treatment and R&R, or receivable and residual treatment, for lessors. I'll talk about that on the lessee side of things here. The lessee models, there'll be an option to account for short-term leases using the operating lease method, and short-term leases, there's a precise definition. It's leases with a term of 12 months or less without the option to renew. And the reason why they added that without the option to renew is to avoid financial engineering structures that still get off-balance sheet treatment, yet allow the lessee to control the asset beyond the lease term through renewals. Now, the right of use model for lessees says that the lessee recognizes as an asset the right to use the leased asset, and recognizes a liability to make lease payments. Now, the boards have decided that there are two types of leases. They haven't really decided on a name yet, but during one of the iterations, they named them SLE leases, which stands for single lease expense leases, and I&A leases, which means leases that have an interest and amortization component. The SLE, or single lease expense, is going to be just like today's GAAP for operating leases, where the lease expense is going to be a straight line average of the rent, the minimum lease payments over the lease term, whereas the I&A accounting method is going to be just like capital lease accounting, where the asset is amortized, where the right of use asset is amortized straight line, and the liability is accounted for using the interest method, such that the P&L cost pattern is front-ended versus the SLE method, where the lease cost is level. And some of the key issues that I'm going to be talking about where there are problems is centers around the fact that they want to account for all leases the same, and that is that all leases transfer a right of use, whereas I feel that some leases transfer actually ownership rights, and some, which are the existing capital leases, and those leases, like the current operating leases, merely transfer a right of use. And they're having kind of trouble with the fact that they do want simplicity, and they fail, that they do not want to carry forward the kind of risks and rewards classification tests that do identify which leases create tangible assets and real debt for lessees, and which leases create intangible assets and liabilities that are not debt, and those being the operating leases. But we'll get into that further on. And additionally, the other problem that they're going to have, I think, which will create quite a few comment letters, is the fact that the classification tests are different for equipment leases and real estate leases. But we'll get on to that in the next slide. Okay, in this right of use model, as I said, that the lessee is going to recognize a right of use asset, which is an intangible right to use the underlying asset, and a liability to make payments under the lease. On the other hand, the lessor will either record a receivable and residual if the lease is an I&A lease, or recognize PP&E on balance sheet if the lease is an SLE lease, or single lease expense lease. And so basically, lessors are going to be using a direct finance lease type accounting method, or an operating lease method. And lessees will be recognizing assets and liabilities, but certain leases will have accelerated lease costs. Certain leases will have straight-line lease costs. And the initial measurement on the lessee side of things is the present value of the minimum lease payments as newly defined. And on the lessor side, the initial measurement is going to be the present value of the rents received over the lease if it's an R&R lease, as well as the residual, which is also the present value of the expected residual. Or else, if it's an SLE lease for a lessor, the initial measurement is going to be the cost of the asset. The rates that will be used, the lessee will use the incremental borrowing rate unless they know the lessor's implicit rate, which they seldom ever would. And on the lessor side of things, the interest rate is the implicit rate in the lease. Now, they define a lease as a contract in which the right of use for a specified asset is conveyed for a period of time in exchange for the obligation to pay rent. Now, the specified asset, it's going to be basically the same scope as the lease standard today. That's property, plant, and equipment, plus certain types of inventory like spare parts, which really are more like PP&E in any case. And that the lessee will have to have the right to control the use of the specific asset. Control is now kind of the regime du jour from the Revenue Recognition Project. And interestingly, they're not going to give any guidance on what's a purchase and what's a lease. They really could have in the scoped out capital leases, but they chose not to, and that leads to that will lead to problems, as we'll discuss further in this presentation. And the new on or off balance sheet switch is really in the definition of a lease. What's a lease versus what's a service contract? Service contracts will remain off balance sheet. Now, leases that contain both a lease component and service component, and this is common for real estate leases where there are leases that are gross leases where the lessee pays for things like utilities and other common charges. Also common in full-service truck leases and PC leases and medical leases where the lease might include supplies as well. Since under current GAAP, those leases that I mentioned, gross leases and full-service equipment leases, both the lease portion and the service portion were considered executory contracts. On the lease side, that meant it was an operating lease. Both the lease and the service component were off balance sheet and accounted for as service contracts, where the average contractual expense was accrued. But now that we're capitalizing leases, a contract that contains both a lease and services will have to be bifurcated, both by the lessor and lessee. Lessors, it's pretty simple because they know the pricing of each component, and revenue recognition will give them some guidance, considering it's a multiple element contract, and they should be able to bifurcate pretty easily. Lessees are the ones who aren't going to have the problem because they may have incomplete information, and so they'll have to either use observable prices, meaning a price for an equivalent lease only contract, or the price for a services only contract, or they could use a residual method where if they knew the price for a similar lease contract, they could back into what the cost of the services are. But if they can't separate the items using either observable prices for both or the residual method if they could observe one price, they're going to have to include those service payments in the capitalization, and that's a significant problem. As an example, in a full-service truck lease, one example I saw, the lease alone would capitalize for something like 85% of the truck's value, but if you included the service portion in the capitalization calculation, assuming that you couldn't bifurcate the two, it would capitalize to over 120% of the truck's value. So I think lessees are going to put pressure on lessors to give them a bifurcated bill, because otherwise the default is that they have to capitalize the full value of the total payment. The lease term is going to be very similar to today's GAAP. It includes the non-cancelable period plus any optional periods where, and this is kind of new terminology, where there's a significant economic incentive to extend or terminate the lease. And that significant economic incentive means that if the rents are a bargain, or the renewal rents are a bargain, or if the renewal rents are compelling because of other reasons, and then an example of that might be, suppose a lessee was leasing some office space and they did significant leasehold improvements such that they'd suffer an economic penalty if they failed to renew the lease and amortize their sunk costs over a longer period. That's the kind of the compulsion test that exists in today's GAAP, and now it seems that we're just calling it by another name. So in other words, bargain or compelling renewals they'll have to be added to the non-cancelable lease term to determine the lease term for purposes of figuring what rents have to be capitalized. Purchase options are also going to be included if there is a significant economic incentive to exercise, basically meaning if the purchase option a bargain, and then it's got to be included in the minimum lease payments, so that you basically have what you would have considered a capital lease under today's rules. Okay, the payments are going to include the fixed contractual payments in the lease, variable payments, except only those that are based upon an index or a rate. An index being something like CPI, which is common in real estate leases, or a rate like LIBOR in the case of floating rate leases. And what you would use to calculate the variable payments is the spot rate. So in other words, if you have a floating rate lease, the spot rate at the inception of the lease that defines what the lease payments are would be what would be used to calculate the rent payments that are to be discounted. When the rates change such that they change the contractual payments, and as an example, CPI, the change is typically done once a year. So when the variable payments change contractually, the lessee is going to have to include the new higher or lower rents in their capitalization. Termination penalties would have to be included if one is assuming that there's a significant economic incentive not to renew. Residual guarantees only to the extent that a payment is expected under the residual guarantee are included. And of course, the exercise of a bargain purchase option is included in the minimum lease payments. Now, contingent rents based upon performance or usage would be excluded and recognized more or less as incurred. But if there are contingent rents that are not truly variable rents, in other words, what in common parlance today would be called a disguised minimum lease payment, you would have to include an estimate of contingent rents that are not truly variable. In other words, there are leases out there, and a good example would be mall that wants an anchor tenant to come in and wants to give them a very favorable lease, the lease might be based entirely upon contingent rents based upon sales. So there aren't any minimum payments. They're just a variable rent based on sales. Now, we would all expect that there will be rents due every month. So in that case, since there aren't any contractual rents, but the rents really aren't truly variable payments, an estimate would have to be included because, in effect, there is a minimum lease payment that one could estimate in that kind of a lease. Another example is that you only have to pay rent if the sun comes up tomorrow morning. Well, that would not be considered a variable rent. Now, the lessee will have to reassess any of the estimated rents and would have to rebook the lease in the case that any of them change. For instance, if it looks like if there's a change in the assessment of the expected amount to be paid under a residual guarantee, the lessee will have to recalculate the present value of the rents, make an adjustment to the right-of-use asset, make an adjustment to the liability, and recognize the new amortized cost of the asset and the new imputed interest on the liability over the term. To simplify things, they say you could use the discount rate that you used at booking to simplify it somewhat. And in those variable rents based upon an index or a rate, the lease would have to be rebooked when the index or rate changes such that the contractual rents have changed. Okay, there are two types of leases. There are interest and amortization leases, I&A, which has a front-ended lease cost pattern, and there are single lease expense leases, which have an expense pattern that's very much the same as current GAAP for operating leases. And the classification tests are dependent upon the asset type, which I think, to me, it's kind of a break from the principle that the whole new regime is based upon, and that is that we should be accounting for the rights and obligations, not the underlying asset, and we should look at the rights and obligations to determine which leases are actually finance leases and which leases are really just executory contracts or operating leases. On the income statement for I&A leases, there'll be an imputed interest expense and a straight line amortization of the asset. And for the lessor side of things, the lessor is going to have a receivable, which is the PV of the rents, and a residual, which is the PV of the expected residual. And they're going to de-recognize the asset and replace it with two assets. Meaning they're going to remove the leased asset, or the underlying asset, from the balance sheet and replace it with the PV of the lease payments and the residual. And they're going to recognize interest based upon the effective interest rate method. There also is still a provision for sales-type lease accounting where you'd recognize an upfront gross profit, except that you're only going to reflect the portion of the profit that relates to the present value of the receivables. The residual portion is going to be deferred, and that's a change from current GAAP, where if you have a direct finance lease, you can recognize all the profit up front, even if you have a small residual. The underlying principle, which I disagree with, is that single lease expenses, that the SLE model will be applied to property leases unless the lease term is for a major part of the economic useful life, or the PV of the lease payments is for substantially all of the fair value of the asset, meaning that it looks and acts and smells just like current GAAP. where if the lease term is for a major economic portion of the life, or the PV, the payments are equal to or greater than 90% of the cost, you have a capital lease. But here we're saying that real estate leases will get current GAAP operating lease accounting P&L treatment, but for equipment leases, the classification test is far different. In an equipment lease, they presume that the equipment lease is an I&A lease, meaning they presume that the equipment lease is equivalent to a capital lease, even though legally it's still an operating lease or an executory contract, unless the lease term is for an insignificant portion of the economic useful life, or the PV of the lease payments is insignificant relative to the FV, future value, or fair value rather, of the leased asset. This is a significant change. It means that to have an equipment lease treated like an operating lease for P&L purposes, the lease term could only be about 10% of the useful life of the asset, or the PV, the rents, could only be about 10% of the fair value of the asset. And as I said, this is significantly different. And this split treatment is going to be the biggest problem that they're going to have with this, because this means that the two types of leases are going to actually commingle executory contracts and capital leases for equipment leases. And lenders and credit analysts really need to know which are the tangible assets and real debt, that is, what are the capital leases, and what are the intangible assets and liabilities, which are the old operating leases, because in bankruptcy they're treated far differently. This is straight from one of the FASB webinars that show how you make the decision as to what's significant or insignificant for other property, which is equipment, or for property, which is plant and property. And you could see that a vessel lease of 5 years for a 40-year lease term, they might consider that to be insignificant, but a 4-year truck lease, which is maybe they consider to be 10-year property, would not be insignificant. So therefore, equipment leases like a 4-year truck lease, an 8-year airline lease, a 20-year vessel lease, or a 3-year car fleet lease, those would all be considered to have front-ended lease costs. This is a significant issue that I think is going to get quite a bit of comment. Carla, could you move ahead?
So, Bill, this actually brings to our first of 3 polling questions, and I'll go ahead and launch this, and everyone should be seeing this momentarily on your screens. Just a quick reminder for everyone who is in attendance today for their CPE credit, you must take all 3 polling questions to receive full credit, but we urge all participants to answer the polling question as it is statistical in nature, and we will share the results shortly at the end if we have time. And at this time, I also want to remind you to continue to ask questions in your question spots within your GoToWebinar panel for our Q&A session. And I'll just give everyone about another 10 seconds here to answer. And Bill, just a quick time check. We've got about another 20, no more than 18, 20 minutes left in order to give us a few minutes of Q&A. So just wanted to give you that heads up on timing.
Thanks.
All right, folks, I'm going to go ahead and close this down now, and hopefully everyone was able to get their answers in.
Okay, move ahead then, Carlo.
Back to you, Bill.
Okay, now we want to get into some lessee accounting, and as I said, the initial accounting is to measure the asset and liability at the present value of the lease payments, and the asset would include any initial direct costs minus any lease incentives. So let's move on to the next slide. Here's what the SLE accounting is, a single lease expense accounting. And you can see that the the lease expense, in the example here, we have a lease with back-ended rents, $10,000 in the rent in the first year, $12,000 in the second, and $14,000 in the fourth. The average is $12,000 a year, and this is what would be reported as lease expense, and the components of that would be amortization expense using the interest method, and a plug, interest expense using the interest method, and amortization expense basically plugging the difference between the interest expense and the total average expense. And here's what the asset and liability would look like. And you notice that there are some differences between the two, mainly because of the pattern of the rents, that we're paying $10,000 in rent, but we're accruing $12,000. That accounts for the $2,000 difference. So this is very much the same as current operating lease accounting, except they make it awfully complicated, where you have to calculate two components and plug one when you really could just accrue the average rent and book the PV of the rents as a right-of-use asset and liability at each accounting period. They could have simplified this. The next slide shows you the I&A accounting, in which is basically to amortize the present value of the rents. Here we have a contract where the present $339 a year rents paid in arrears for a $1,000 list price asset, with an incremental borrowing rate of 7%. PV is to $890, which is booked as a right-of-use asset and liability, and interest is imputed at 7% each year. The right-of-use asset divided by 3 is about $297 straight line per year. And you notice the interest starts out high and reduces. So you have a lease expense that starts off at $359, drops to $339, and is finally $319, whereas the average rent paid was $339, and you can see there's a 6% higher cost in the first year for this 3-year lease than under current GAAP. So that's a big problem. And here's a graphic depiction of what I'm talking about, where the straight line rent expense under current GAAP in I&A leases is replaced by this declining line, which turns around at the midpoint. And if we move to the next slide, you could see what the impact is by lease term. And the longer the lease, the greater the front-ended impact, such that a 20-year lease would have 28% higher cost in the first year. So the lessee would present on the balance sheet the I&A leases and the SLE leases separately, but unfortunately the I&A leases are a commingling of operating leases and capital leases. So the analysts and the lenders who this rules change was written for, that is to give them an accurate calculation of the present value of lease liabilities, they will have accomplished putting the present value of the leases on balance sheet, but that what they will not have accomplished is giving lenders and credit analysts a breakdown between which assets survive bankruptcy, which assets don't, which liabilities are debt in bankruptcy, and which liabilities are not. And the FASB has been told by their Investors Technical Advisory Committee that the proposed rules don't give them as much information on operating leases as they get today. Now, in the income statement, the I&A leases will have interest and amortization. The SLE will have a single lease expense, much like rent expense. Cash flow statement, SLE payments are considered an operating outflow, whereas I&A are considered principal and interest. And as I said, there's a commingling in the I&A of what I would consider equipment leases that should have gotten SLE treatment. The disclosures for a lessee are going to be extensive, including things like a roll-forward analysis for both the I&A and the SLE leases, a maturity analysis of future rents, but again, as I say, if they're going to be commingled, because the INA leases will include what were formerly operating leases for equipment, and also they're going to ask for a maturity analysis of service payments included in leases, which I think is a little bit strange because no one has to report future service costs for assets that are owned, but that's my own opinion. In transition, lessees can choose a full retrospective approach, or they could use a modified retrospective approach, where under the modified method, the liability is measured at the present value of the remaining lease payments for any existing lease. And the INA leases, which have a front-ended lease pattern, in order to mitigate the impact or the hit to P&L in recording all existing leases as though they were new leases with a front-ended cost pattern, they allow you to make an adjustment to the ROU asset, but that just means that in transition, upon booking of those leases, the hit that would have hit P&L in the first year is a hit to equity. So I don't think it really solves the problem of front-ending costs in operating leases, which are really rentals. The discount rate is going to be the incremental borrowing rate on the effective date, and the lessees don't have to adjust existing capital leases. The lessor models, I don't want to focus a lot on lessor, so we're going to move quickly here. As I said, there'll be a receivable and residual method and an operating lease method. The receivable and residual method is very similar to today's direct finance lease method, whereas the operating lease method is also similar to today's method, so there isn't a lot of change for lessors. I think I've already explained a lot of this already, so let's move to the next slide. Here's an example of a lease with a lessor lease with that's a sales type lease, meaning it has a manufacturer or dealer's profit, and so a lease receivable is going to be recorded, and the profit on the lease that was $2,500 will be partially deferred based upon a ratio of the residual to the total fair value. But otherwise, it's the same as current direct finance lease accounting and sales type lease accounting. I think in an effort to save time, we should continue. And this is a summary of the example showing the profit recorded under the proposed method and the profit reported under the current sales type lease accounting, and the difference between the profit recognized in the two. In the beginning, this is the proportion that this reflects deferral of the residual portion, and the difference between the total revenue recognized under the current method and the existing method is the deferred portion that will be recognized upon sale of the residual. Let's move on. I think we should move on. This slide talks about the balance sheet and income statement. I think it's self-explanatory. One important note, though, is that leveraged leases will be in this slide here. I think the important thing to note is that leveraged leases will be rebooked and grossed up, and that's a significant change from current GAAP. I think we have to move on to the next slide.
All right, Bill, so we're actually to our second of 3 polling questions, and I'll be launching this, and everyone should be seeing this on their screens here momentarily. And again, just a quick reminder to those of you in the audience who are here for CPE credit, you will need to answer all 3 of our polling questions. And at this time, I also want to remind you to ask questions in your questions box within your GoToWebinar panel. We will be getting to our Q&A session here shortly. And I'll just give everyone about another 20 seconds here to get everyone in.
Yeah, I think this is self-explanatory. In the things that I have listed in green are good news. When you look at products, the track leases, split track leases, synthetic leases, true leases, the capital and operating leases, they will be capitalized at less than the value of the asset, so there still will be an accounting advantage. Sale leasebacks, there is an issue. Any sale leaseback with a purchase option will not be considered a sale. And manufacturer issues, although I don't see many, I haven't heard many manufacturers having a major issue, but there will be some deferral of profits. Yeah, this is also self-explanatory. Again, it talks about the product, so I think we should move on. The impacts from a lessee perspective, the industries that are most impacted are going to be retailers and banks because of their heavy real estate leasing, transportation companies because of their asset intensiveness. Banks are going to have new capital needs because they'll have ROU assets on the books that the regulators are going to have to decide how they treat those. The FASB has decided not to call them tangible or intangible, but it's going to be a new asset, new capital needs, or at least a decision by the regulators. Front-loaded costs and deferred tax assets caused by front-loading of costs faster than their deductible are going to cause capital needs, and reversal of earnings in any gross up on the balance sheet of leveraged leases for those large banks that have them are going to be a capital issue. Lessees may have debt covenant breaches if the FASB doesn't properly classify operating lease obligations as non-debt. Property tax compliance is going to be more difficult for lessees because the property tax rules define or say that property tax is only due on existing capital leases, and if they commingle capital leases with operating leases, people are going to have to keep 2 sets of books for property tax compliance. And for lenders and analysts, a preparer may have to provide information on capital leases versus operating leases under existing rules to allow a bankruptcy analysis. Important information for prospective lenders and analysts to know which assets and liabilities survive bankruptcy. The operational impacts, transition and implementation for lessees are going to be major projects needing system support, and it's a complete change in how things work because there's going to have to be extraction of information on operating leases that are going to have to be booked, and there's going to have to be this monitoring of potential changes that will require major process changes for lessees, especially in real estate. Lessor issues, not such a terrible change, but I have an issue with classification. It should be based on business model. Finance lessors should have direct finance leases. Operating lessors should have operating leases. Loss of leverage lease accounting and loss of the ability to include tax credits and revenue recognition is going to be an issue, and it's going to really affect the cost of leases to lessees because both of those allowed lessors to improve pricing. Service contracts, because of the definition, fewer arrangements will be considered leases than under current rules. Sale leasebacks, this I think is an important issue. Under the rules of revenue recognition, any sale with an option to buy back at less than the sales price is considered a financing, and many leases are done through sale leasebacks more for convenience than anything else, and so that's going to be an issue that we hope that they would have addressed because we think out-of-the-money purchase options should not affect sale treatment, but that's unfortunately our opinion and not theirs. Yeah, I think we've concluded the presentation. I'm sorry I had to rush it. I think my take on this whole project is that it's very close to being a workable set of rules, but the major issues for lessees are the illogical classification process, which differs from the legal view of a lease, and the cost allocation, which considers executory contracts to be financings. From a lessor perspective, I think the biggest issues are lessor classification, not being based upon business model, and the inability for lessors to recognize tax benefits and revenue recognition. I thank you all for listening, and sorry I was a bit rushed there, but that was my own fault in not sticking to the time slot.
No worries, Bill, and we truly appreciate your time today and the insights you provided. So we'll go ahead and jump into Q&A here, and we do have a few questions coming in from the audience. So what we will look to do here is try to answer as many as we can in the short period of time. We do have, if not, you do have the opportunities during the post-event survey to ask for an introduction to Bill. If you'd like to follow up with him directly on some further questions, but he will work with us to answer the ones that we do not get to during today's Q&A. So let me go ahead and kick it off. Is there a difference between the private-public sector in regards to how private companies and public companies need to, account for it as a leasee, or is this directly across all companies?
Well, it is going to be. This will be U.S. GAAP, although there is a project to define what public company GAAP is and what differences there are. So what private company GAAP is. So there might be some relief for private companies, but currently that has not been decided.
Gotcha. And then another question here, and it's actually one from the equipment leasing industry. What's the best method to get heard? Obviously, in a time of the economy just recovering, and it's very difficult for a lot of people to still better understand not only the principles and the rules, but also what are the business model and the value from a margin perspective. How can people be heard to get their comments in for the new proposed rules?
Well, what you should do is log on to the FASB website and download the exposure draft when it's issued, and they'll give you instructions as to how to submit a comment letter. You should also look at my website, which is www.leasing-101.com, and also look at elfaonline.com, which is the Equipment Leasing and Finance Association's website, and both websites have a lot of information on the project and give some comment letter guidance or suggestions for comment letter issues and rationales. So I think there will be resources on my website and the ELFA website to help people, but really read the exposure draft and comment yourself.
Great, thanks, Bill. And I'm going to ask you one more question, and we do have a few more in queue, so we will work with those folks to answer them post the event. But and I apologize to all the audience members that we did not get to. That this is just more kind of in general. Is there any software programs other than Excel that really help to calculate the present value and the I&A calculation?
Well, it is a simple calculation. Maybe I'm oversimplifying it, but one could do it using Excel or a financial calculator easily. But if you're a business, I think you've got to look at software companies or look at internal changes or internally developed software, because if you have a decent-sized volume of leases, you're really going to want to either look for commercially available software or develop it on your own.
Great,
I don't know. I'm really not in a position to recommend anything, but there are a number of software vendors. If you're an equipment if you're an equipment lessee, I think, or an equipment lessor, the ELFA website probably contains service providers, which might be a good start for you to find someone who could help you with your IT needs.
Fantastic. Thanks, Bill, for that. I appreciate it. And so to all of the attendees, we will work with Bill to answer all of your questions that have been left unanswered at this moment. I apologize for it. And just a few last housekeeping items before we end the webinar today. You will be prompted at the end to participate in a short survey. We truly value your feedback and appreciate the time to help us continue to deliver this great content. And at that time, you can easily request to connect with Bill with the click of your mouse. We also ask you to continue this discussion on proformative.com. And if any questions around CPE credit, please contact Chris Brower at proformative.com. And just a brief reminder to everyone to fully take advantage of the early bird pricing for our CFO Dimensions conference. It's going to be held in New York City on August 21st and 22nd. Great conference with some world-class best practice speakers discussing different case studies around strategic leadership and finance. And now on to our third and final polling question for today. I will be launching this, and you should all see this momentarily. And I want to just take this time to thank you, Bill, again for your time and insight, and you, the audience, as well, for your time today. And once we do complete this polling question, we will launch the short survey, and at that time you'll have the opportunity to request a connection with Bill and also request more information on CFO Dimensions with the click of your mouse. I'll leave this open just for a few more seconds. And we thank you all again. We hope to see you again on another Proformative event or online at proformative.com. Have a great rest of the day, folks. Goodbye.